Morgan Stanley studied decades of stock market history and nailed down the best areas that protect against huge portfolio losses. A team of nearly 3 dozen analysts recently compiled a scoreboard of the best defensive sectors based on their study of nearly 25 years of market data. They acknowledged it's a limited time frame that spans 3 cycles at most and is skewed by the tech bubble and the credit crisis. Still, they considered the study a good starting point for thinking about the next downturn. Michael Wilson, who is the chief U.S. equity strategist, said last year that higher interest rates and less synchronous economic growth would lead to more volatile markets. He now reckons that an extended bear market may already be underway, but will lack the big 20 to 40% pullbacks that characterized the last 3 bear periods dating back to 1987. We think a rotation to more defensive market leadership is coming later this year and into 2019 as the market begins to contemplate slowing growth and an aging cycle. Before that rotation begins in earnest, we tested traditional notions of defensiveness and assessed if what was defensive in the past will continue to be so in the future. So let's take a look. And this is a chart from Morgan Stanley. And as you can see in the upper left, such as energy, consumer staples, healthcare, and utilities, these are the areas, the sectors that Morgan Stanley believes have a more defensive and a better risk reward scenario, as opposed to those stocks there on the lower right, which include financial, telecom services, industrials, materials, and construction. Those are the areas that are less defensive and are going to have a worse risk reward. So this sort of dovetails into what we've been talking about for months. And we've looked at consumer staples such as Kellogg's that has been in a bear market for years. And we've also looked at REITs and utilities and energies, all of which have gone through similar bear markets. And that's what makes this market different this time. I know you've heard that statement before, and it never is different this time, but I think that this time, at least with regard to the rotation, that is different. Instead of the stocks all going down at once, like during the dot-com bubble or in the great financial crisis, we're having a rotation. So this time, we may be able to find some areas to shelter our portfolios and hide from a downturn. So after we go through a few sectors, I'm going to end up with one last chart for you to take a look at. And at that time, I'm going to give a challenge to Snowfire. So let's continue. Beginning with the aerospace and defense industry, aerospace on its own is a cyclical business because it relies primarily on the airline industry, which tends to sway with the economy. However, defense stands out as one that generates revenue from the government even when the rest of the market is faltering. So, given that the Trump administration has requested $716 billion from Congress for 2019 defense spending, that's a 13% increase over 2017. Therefore, this sector is considered bullish. And the top pick by Morgan Stanley is Lockheed Martin. And what we're looking at here is the 20-year monthly chart on Lockheed Martin, and the symbol is LMT. And for disclosure purposes, I don't own any stock in any of the companies that we're going to be talking about here today. And looking at Lockheed Martin, it had a top that was here well above 350 and has been heading down since then, just now resting on the 20 EMA. But as we can see here in the MAC, in my opinion, we've got some acceleration on the downside with the fast line piercing through that slow line pretty convincingly. So in my opinion, we're still heading down. So I'm not sure if I would head to Lockheed Martin for cover. Going here into the histogram, same thing, very steep drop off, as well as in the RSI. It's below 50, not much, but it's below 50. 50, a pretty good steep sell-off in, say, since the beginning of the year. So the last 6 months we've been heading down, and no real sign that this is going to stop anytime soon. The Williams is heading on down. It'll probably bounce at the bottom, but the recovery is going to take some time. I don't see any signs of any recovery at this point. So yes, it's in a downtrend. I'm not sure if it qualifies as a bear market yet, but that's a pretty significant downtrend. So for me, I would be staying away from Lockheed Martin. The next sector highlighted is beverages, and the higher pricing power of the companies and higher growth outlook are among the reasons why this is one of the best defensive sectors. One concern that Morgan Stanley has for household products in general is that competition from Amazon and discount retailers could keep prices in check. Well, that's good for you as a consumer. It could mean less revenue for the company and you as an investor. Beverages, however, don't face that headwind as much because of the diverse locations at which these products are sold and the fewer private label offerings versus household and personal care products and immediate consumption of beverages. And Morgan Stanley's pick in this sector is PepsiCo. And along with PepsiCo, I would also highlight Coke. And Coke, I'm not sure if we've looked at that in the past, but it has a great cycle. It's a very predictable stock. You take a look at that stock, Coke, on a long-term basis, and it's been very predictable for, say, the last 5 to 7 years. But we're looking here at Pepsi, and the symbol for Pepsi is PEP. And as you can see, it topped out here, say, in early 2018, just above 120. And we came all the way down here to below 100. So that was, I believe, qualifies as a bear market. Not doing the math exactly, but I think that's probably close enough for our purposes. So Pepsi, going on down here to the MACD, it does show that there is a little bit of a sign of a bottoming process in here. And if you go back into 2009, that's what it looked like here. And then back into 2003, that's what the bottom looked like at that point. So not all that dissimilar. But I'd need a few more oscillators to show me that this is slowing down and bottoming for sure. The MAC histogram does show that things are improving here in the last couple of months or so, so that's favorable there. But this is pretty deep. Going down here to this -2, it's only come down this far since 2009. It did not get down that far in 2002, 2003. So I would imagine that we're going to need a little bit more time in the bottoming process here. But the relative strength also bottomed back up to the 50 at that point there. The stochastic as well has bounced off whatever level that was and headed up into the fast line, headed up into the slow line there. May have a little bit more time before it goes through that. Volume looks fine, and then of course the Williams also looks fine. A good bounce here in actually early 2018 up to the midline here at this point. So things are looking favorable for Pepsi. So that's possibly one that you want to look a little bit further into. Certainly you want to take a closer look at those fundamentals to see if this qualifies for your portfolio. The next sector is integrated oil and gas. And Morgan Stanley's analysts, like those at Goldman Sachs and Citibank, are bullish on energy. Higher oil prices, light positioning among investors, and relative valuation are among the other things that make energy an attractive sector. With respect to integrated oil and gas specifically, beyond a bullish outlook on oil, Morgan Stanley sees additional support from what they think will be a new golden age for refining, as underinvestment in refining, slippages in capacity, and overdone concerns on long-term demand set the stage for the refining upcycle to inflect into a golden age through or into 2020. So Morgan Stanley's pick in this sector includes Chevron and ExxonMobil. And I'm just going to go through ExxonMobil because I don't agree at this time that Chevron is a good stock for your portfolio simply because of the cycle that its price is in right now. I think it's a little bit overpriced. Now, with regard to ExxonMobil, I've done some reading on that. I don't know for sure, but if my recollection is correct, there were some issues with ExxonMobil, perhaps the lack of exploration or something like that. So we'll go through Exxon here, but before you do any investing in Exxon, you're going to need to have to study more of those fundamentals. But the price chart looks decent. It had a bounce here just above 70 and came up into the 20 and the 50-day EMAs at that point there. So a little bit of a struggle at that point. Here, the MACD doesn't look too bad. It looks like it's below zero, so a little bit of weakness, and it's been, say, going sideways for the last couple of years. So I don't think it's going to break out to huge proportions here, but it might be a decent time to buy. The histogram shows pretty much the same. Relative strength is, there's nothing all that exceptional here in the RSI. The stochastics are heading on up after bottoming back here, say in mid 2017, and a little bit of retrenchment in early 2018, but back up there to the 50 line. And then volume looks fine, and then the Williams looks okay to me as well. So you're going to have to do a little bit more research on ExxonMobil. There's nothing really all that exciting or compelling to me about this price chart. I'm not sure what the dividend is. I'll bet you it's probably pretty healthy, so that would be another favorable characteristic. But overall, it's something to look at, but it would not be high on my list for my portfolio. And this last sector here is utilities. And according to Morgan Stanley, at a high level, U.S. utilities contain one of the lowest risks among all industries because these companies are permitted to earn a certain rate of return on capital deployed and operate under exclusive mandates that are perpetual in nature. And further, they state that there's a surprisingly large differential between or in earnings per share growth potential and business risk among U.S. utilities. Currently, Morgan Stanley favors several high growth electric utilities that are benefiting from increasingly cheap renewable energy. Morgan Stanley is more cautious on several gas utilities given they typically trade at a multiple turn PE premium to electric utilities and often do not offer higher earnings per share growth. And the top picks in this sector include First Energy and American Electric Power. And First Energy I looked at, it's not compelling either. So I'm going to go through American Electric Power, and I would imagine that the dividends on these are pretty decent. And it's somewhat interesting that American Electric Power, it has a cycle somewhat like Coke does. But looking here, AEP, 20-year monthly chart, and it looks like we bottomed here, just bouncing off of the 50 EMA, moving up through recently the 20 EMA. And down here into the MACD, we see that the MACD looks like it's doing a turn at this point in here, and it's got several turns that you could take a look at for comparison purposes back there. Nothing down as low as 2009 back here in 2003 or even here. So we're above zero. So there is some strength in this sector. So that's surprisingly favorable in my mind. The histogram is showing us much the same. The relative strength, we're again down below 50. We bounced. Now we're above 50. We have a kind of a divergence going on there. So that's something that you want to keep your eye on, both on the upper and lower portion of that channel. So keep an eye on out for that. The stochastics looks fine. Looks like we're going to bounce similar to other periods back here and maybe head on up. Looks like it's not too bad there. Volume is decent as well. And then, of course, the Williams looks pretty much the same as it has in the last several years. So perhaps a repeat of what we have seen for the last 4 or 5 years. Back on up here into the price chart, it looks decent in my mind. Again, continue your fundamental analysis on this and every other stock that we've taken a look at before you add that to your portfolio. But these are perhaps some candidates to help you hide from any significant downturn in the market. So I've got one more chart to take a look at. So let's go there now. And this last chart here is Berkshire Hathaway, and the symbol is BRK/A, at least on this website. Sometimes it's BRK.A or BRK-A. You'll have to check with whatever chart you're looking at. And I'm not sure if this price is actually going to come through once editing is finished, simply because it's relatively large, but you can see that the last price on Berkshire Hathaway was $283,700. So I want to take a look at Berkshire Hathaway for a couple of reasons. First of all, this has to do with my challenge with regard to Snowfire. And I don't think it's anybody's secret if you've been reading the notes or comments on different videos. I think it's public to everybody. Snowfire has the plan, the goal to get 500 shares of various different stocks for dividends and for perhaps retirement. And I know that Berkshire Hathaway does not have a dividend, but here's my challenge, Snowfire. Why don't you try to acquire 500 shares of Berkshire Hathaway? That's my challenge. And if you're able to do that, at least at today's price, that would be $141,850. So, oh boy, good luck with that. But I'm cheering for you. Now, I think, Snowfire, that I'll give you a little bit of help here. In my opinion, Berkshire Hathaway is on its way down. Berkshire Hathaway is such a large stock with so many companies that it serves as a proxy for the overall market, like the S&P or the Dow or even the NASDAQ. Now, the Dow, the S&P and the NASDAQ have not moved down as far as I think Berkshire Hathaway has, and you'll see here that in a second. I think things are going to continue to erode for Berkshire Hathaway since they have, say, about the beginning of 2018. We're down here above the 20 EMA still. May get a bounce, but I think we're going to go through that. And I say that simply because looking at the MACD, the fast line topped here and headed on through the slow line at this point, and it looks like it's continuing on down. I don't see any slowing down yet. And if it does anything like it has in the past here, perhaps here, and certainly in here, I think we have further to go down, and that's shown here in the histogram as well as in the relative strength. A little bit of a bounce at the 50 line on up, but I think that's only temporary. We'll have to wait and see. I'll bet you this gets down below 50 in subsequent months, but we'll see. Stochastic is continuing to head on down. No real sign of slowing there. Volume, not even pay attention to this. I'm not sure what's wrong with this chart, but I'm not going to worry about it. The Williams heading on down below that 50 line here too. No real sign of stopping. Back on up here to the price chart again. I think we're going to have perhaps a hesitation here. It bounced off of the 20, or actually kind of moved through the 20 and then bounced off and headed up here at that point. There aren't too many other periods here where it bounced off the 20. It kind of wrestled in this area here, but that was after coming all the way down, and then it headed up. I think we have further to come down with Berkshire. So even though the other indexes, the S&P, the Dow Industrial or NASDAQ, haven't moved through, the fast line on the MACD has not moved through the slow line, I think that's going to be happening at some point here in the future. But it is, at least for Berkshire Hathaway, so that's just another red flag for me, showing me that the overall market is slowing down, and we may have, I can't say we're going to have a bear market or a crash or anything like that, but definitely we're going to have those rotations that we've talked about before and also in this video. So pay attention, save your cash. You're going to need it for a reserve and deploy it when those opportunities come. So the last message is, if you want to know what's happening in these markets, subscribe to this channel. So for today, that's ChewDog Charts. Thank you.